My dear friends. How have you been? Welcome back to Raya's studio. I am Raya. In June of 2022, our technology partner Guaizu wrote an article titled, Subprime Crisis in the Cryptocurrency World. At that time, we were met with the collapse of Luna and Three Arrows Capital. Meanwhile, Guaizu had 5 predictions. 1. Bitcoin will not drop to 0. 2. 17,500 is not the bottom. 3. The current round of cryptocurrency bear market is very likely to become a once-in-a-decade cryptocurrency subprime crisis. 4. Global inflation will continue until 2023 before it starts to decline. 5. The cryptocurrency bull market will open again in 2024. The second and third of these predictions have now been confirmed. Especially the third prediction, the part about the cryptocurrency subprime crisis, as the collapse of FTX has proven. And this time, regarding FTX, since the internet has a lot of detailed articles about it, I will not say more. If I were to do a short summary, it is a story about one of the world's top 3 exchanges, with a market worth $16 billion. That got an article written by CZ which caused many customers to run, eventually leading to bankruptcy due to insolvency. The lesson for everyone is, don't give your money to a trader, because he certainly won't be able to resist embezzling user funds for trading. After the whole FTX fiasco, Guaizu made a new prediction and also projected the future crypto market for everyone. Let's take a look at what he actually said. 1. Bitcoin will not drop to 0. This is the same prediction as in June. 2. 15,600 is not the bottom yet, but it is very close to the real bottom. 3. Exchanges and DeFi-related projects will continue to collapse in the near future, but not all of them will be destroyed. 4. The real deep bear market in the cryptocurrency world is coming, and the time to really bottom fish is coming. 5. Global inflation will continue until 2023 before it falls, and the Fed will start to turn in the second half of 2023. 6. The once-in-4-years bull market in the cryptocurrency market will start again in 2024, which is also the same as the prediction made in June. Let's take a closer look at the following. First prediction. Bitcoin will not drop to 0. The first prediction is unchanged from the previous prediction, although recently there have been more and more people talking about Bitcoin going to 0 and whatnot. Please note that these statements are bound to appear every time a bear market proceeds to a certain point. I think that in terms of both the ecological development of the cryptocurrency community and the number of long-term holders holding their positions, there are more long-term holders holding Bitcoin in this bear market than before, and the ecosystem of the cryptocurrency community is richer. The next 10 years will only be better for the cryptocurrency community, so don't miss out on this 10-year bear market if you want to be wealthy. As for those who still think Bitcoin will go to 0, let them pick up the pieces when the next bull market reaches its peak. Number 2. The $15,600 position is not the bottom yet, but it is very close to the real bottom. For this, we need to look at a technical graph. This is a weekly chart of Bitcoin. Please note the part marked as the collapse of Luna, Three Arrows, and FTX, as well as the drop. In terms of the drop of people fleeing the market, it appears that the strongest drop was from Three Arrows, followed by Luna, and finally FTX. The absolute decline in FTX has actually weakened a lot, compared to the decline in Luna and Three Arrows. What does this tell us? On a technical analytical point of view, to a large extent, the prediction of trends is connected to the strength of the trend. The theory is that if the strength is weak, and the price continues to drop to new lows, it will certainly form a divergence. And once the divergence appears, it means that the trend will have a fairly large probability of reversing. Now let's zoom in on the MACD portion of the weekly chart. On the weekly MACD, you can see that when Bitcoin formed a bottom golden cross, shortly after the Three Arrows crash, the fast and slow lines approached the zero axis. The bottom rose. and the crash weakened. While a dead fork below the zero axis might form again after the FTX crash, but unless there is a bigger and stronger crash than the current FTX one, a new and higher, bottom golden fork, will form above the previous one, thereby forming a divergence as strong as that of a weekly levels. Additional note: according to the strength of the divergence, there are three kinds of divergence: Class A divergence, Class B divergence, and the weakest, Class C divergence. Let's try drawing a graph with two golden crosses below the zero axis of MACD, as shown in the chart. Once the latter position is higher than the previous one, the weekly Class B bottom divergence is formed. A weekly reversal is also possible. According to the theory of Guizhou, a major reversal must occur at the sublevel divergence. Let's go back to the sublevel daily chart. From the daily chart, it actually looks clearer that the previous wave of bottom golden cross was lower and stronger, while this wave, despite breaking the previous low, was weaker in comparison. It is also foreseeable that in the next few weeks, as long as nothing crashes harder than FTX, then a new daily level, bottom golden cross, will form again, and the position will be higher than the previous wave. Such a pattern will constitute a daily level, strong divergence. Likewise, it may also be expanded into a weekly level, Class B bottom divergence, and a reversed pattern may take shape. So, why did this happen? In fact, if you think about it carefully, it's easy to understand. Most of the casual investors and even many institutions left the market in the first wave, when more than $40 billion were loose in the Luna, 3 Arrows, fiasco. The total debt of FTX was actually only about $9 billion, which meant that the gap wasn't too big. If we simply look at the gap in capital, the hammering for FTX was definitely not as strong as the previous two. There will definitely be similar cases like this in the future, but as long as they aren't as serious as FTX, the technical pattern will not change. After all, the remaining money left in the market is very little. To hammer the market, you must first have the coins to do it. Therefore, as long as we don't encounter a substantial forced liquidation or bankruptcy, there will not be too much pressure to sell at the moment. Third, the exchange and DeFi-related projects will be collapsed one after the other in the near future, but they won't all go out. FTX is an exchange by its very nature, and is ranked among the top 3 exchanges in the world. The biggest consequence of its bankruptcy is the distrust of the exchange by many casual investors and institutions. Similar to the Mt. Gox incident in 2014. At the time, Mt. Gox, a Bitcoin exchange based in Tokyo, Japan, claimed in February 2014 to have lost about 750,000 bitcoins belonging to customers, as well as 100,000 of the platform's own bitcoins. There were 24,000 creditors. And until now, compensation from Mt. Gox has remained elusive. The total number of these stolen bitcoins accounted for 7% of the global total at the time, and the trading volume of the Mt. Gox exchange accounted for about 80% of the global market that year. As for the price of Bitcoin, it only dropped from $600 to $400, or about 30%, despite being in the middle of such a huge collapse. According to sources that can't be fully confirmed, the theft of Mt. Gox at the time was supposed to be part of a supervised theft. And the FTX exchange today is actually nowhere near that level in terms of market share. So, the drop in Bitcoin was only at about 20%, from $20,000 to about $16,000. Many of the older investors who experienced the Mt. Gox incident back then never trusted any exchange again and put all their coins into cold wallets. But after this incident, the price of Bitcoin has remained firm since, rising from $400 to $69,000 from 2014 to now. Both the FTX and Mt. Gox fiasco were exchange bankruptcies, but they are still very different in nature. Mt. Gox was simple and brutal, since the coin was simply gone. FTX, on the other hand, was a case of SBF misappropriating the assets of its users for investment, and then pledging a large amount of coins issued by its own exchange. This is the equivalent of printing their own money, pulling up the price of their own bills and getting a mortgage. While in a bull market, this wouldn't be an issue, because people will not withdraw their coins, thinking their coins will continue rising. But in a bear market, once people start hearing that even CZ were planning to sell their holdings of FTT, people started panicking and went to withdraw their coins. Once there is a massive withdrawal on the coins, FTX's problems are exposed. Insolvency. At the same time, a large number of users holding FTT lost confidence in FTT. Then came the pressure of having to sell. The price initially fell from near $24 to about $16 almost immediately. After that, FTX had no money left. Many customers could no longer withdraw any money. So the panic selling of FTT happened again. The price fell again and again, towards zero. At the same time, FTX's FTT coins for collateral in the case of substantial devaluation had mandatory margin calls. But FTX having no money eventually lead the situation to become a death spiral. In general, a healthy exchange at least holds more assets than liabilities, and the ideal exchange should have no liabilities. And having liabilities means there is unauthorized access to customer funds. This is the reason why several exchanges, led by Binance, have recently announced their assets. This is to tell customers that their assets are greater than or equal to their liabilities, so that users don't have to worry. Here I can say without a doubt that the quicker one can provide proof of their assets, especially if most of the assets are not their own exchange's coins, the more they can survive. On the other hand, for those who can't provide proof of assets, there is a high probability that users of that exchange will run and either withdraw into a cold wallet or transfer to a big exchange like Binance or Coinbase. The exchanges that have recently provided proof of assets are Bitfinex, Deribit, KuCoin, OKX, Crypto, Binance, Gate, Huobi, etc. But frankly speaking, Huobi, Crypto and Gate have had different degrees of money reversal before and after showing proof. It is better to withdraw coins to other exchanges or cold wallets in the near future. In addition, I understand that Bybit has a strong principle despite not showing proof of assets, and I don't seem to have heard of any big foreign debts. Also, Bitfinex had an incident in 2016, where nearly 120,000 bitcoins were stolen, and has had many problems since. Coinbase, on the other hand, has too much of a spread, and is recently said to be merging pro accounts, and the earnings for their third quarter on report marked a loss. However, as public trading companies in the United States, many institutions, including the ones involved with Catherine Wood, are still at the bottom of the barrel. Therefore the problem should not be too big. For the time being, if you want to trade soon, prioritize exchanges like Binance, Coinbase, or OKX. There are more than 500 exchanges worldwide in this round of bull market. However, in my opinion, many exchanges are bad exchanges that can run away at any time. FTX has done exactly this, misappropriating user assets without permission, which is a habit in exchanges. And it is foreseeable that all the small exchanges that cannot provide proof of assets in the near future will have problems in a short while. At best, they will lock up their users' funds and open them up again after a while. Worst case scenario, they simply disappear or go bankrupt, or have their coins stolen. However, from another perspective, those that survive the exchange credit crisis, even if they are exchange coins, are expected to do well in the next bull market. Regarding whether or not Binance will fall, my view is that first of all, in terms of hacking, Binance has already experienced a massive hack that did not shake BNB's prices at all, and Binance's solution was timely. The probability of experiencing another hack of similar intensity in this bear market is not great either. Plus the run Binance currently has over $70 billion in assets and no liabilities, with BUSD accounting for 33%, USDT for 23.2%, Bitcoin for 9.5%, Ether for 9.95%, and BNB for 8.4%. There will also be a lot of people moving all the coins from the smaller exchanges to Binance. As far as the current asset situation is concerned, it seems to me at least, that they are in a very healthy situation. Finally, will there be a Mt. Gox incident in Binance? My opinion is no. There is no need for CZ to give up his current comfortable life to go to jail. Because once a similar incident occurs, he'll definitely be going to jail. Likewise, even if SBF is far away in the Bahamas, he won't be able to avoid jail time either. As for DeFi-related, I have always believed that in a bear market, we should try not to touch DeFi-related projects, which are living on liquidity lending. New DeFi projects, in order to attract customers, will have to be fancier, which leads to complex lending, and finally a great possibility of collapse. For example, this year, there were many new NFT mortgages. These are basically third-rate projects. NFT liquidity is poor. The bear market is also engaged in NFT mortgages. It's basically like asking for failure. At present, in my opinion, for DeFi projects that seem more secure, I personally suggest starting with Aave, Uni, or Cake. Uni specifically. If you secure it at a slightly lower price, it should have a stable return in the next wave of the bull market. I rarely introduce new coins to people in a bear market. Why? Because it is too risky. The biggest reference for bear market coin hoarding is still to be able to survive. The liquidity of new coins is poor, unless it is similar to Aptos and other superstar projects. The other 99% are going to crash. Fourth prediction. The real deep bear market in the cryptocurrency world is coming, and the time to really bottom fish is coming. We're currently in a real deep bear market in the crypto circle. At this stage, the willingness to trade on the market will decline drastically, and the trading volume will also weaken drastically, forming a sideways market. Since there are fewer people selling, there will be fewer coins on the exchanges, and there will be whales buying tons of Bitcoin when the drop is more than $1,000. The price of Bitcoin as it stands now does not seem to have much of a drop, but due to the lack of big buyers, it is estimated that it will continue to have a narrow sideways oscillation at low levels for a period of time. Many people will definitely exchange their altcoins on hand for Bitcoin in order to play it safe, which will lead to a greater drop in altcoins than in Bitcoin. At the same time, major groups have become inactive. These are the signs of us entering into the deep bear market. For technically good investors, you can do some small cycles of high selling and low buying during this deep bear period, in intervals of 1 hour. As for the whales, my suggestion is to just buy in one fell swoop, and then put it into a cold wallet to hold until 2024 comes. The current mode of operation has changed from the previous short mode on the high side to a plunge mode on the low side. Right now, the price is below the weekly MA200 area, which means you can buy without much thought. According to the technical chart given earlier, it seems that even if there is another crash in the market, as long as it's not as bad as the FTX crash, the drop should not be too big. The crash would likely only belong to the technical plunge range of the bear market. As long as the bottom is in this range, these will all be stable earnings. If you have faith in me, don't miss this opportunity. Fifth prediction. Global inflation will continue until 2023 before it falls, and the Fed will start to turn in the second half of 2023. The Russia-Ukraine conflict, which affects global inflation, has seen a de-escalation of the situation, according to recent information received. On the side of the US, the New York Times recently reported that there is also currently disagreement within the US government on whether to resolve the Russian-Ukrainian conflict through negotiations. Mark Milley, chairman of the US Joint Chiefs of Staff, urged negotiations. The report said. According to an official with knowledge of the situation, Milley said during an internal meeting that Ukraine had made some expected gains on the battlefield before winter arrived, and that they should try to consolidate this at the negotiating table. But senior US government officials with opposing views insisted that neither side was ready to negotiate, and that a pause in fighting would give Russia a chance. For their part, some advisors to President Joe Biden said it was too early to negotiate. For the first time, there is disagreement within the US officials, and so a shift to negotiations on the Russian-Ukrainian war has become a possibility. As for the Russian-Ukrainian side, all units of the Russian army completed their transfer to the left bank of the Dnieper River at 5 a.m. on the 11th, leaving not a single piece of military equipment or weapon on the right bank. This was the first time that Russia showed signs of a possible end to the war, and soon after, the Ukrainian foreign minister said that he was considering the possibility of meeting with the Russian foreign minister. And Sykov, a member of the Committee on International Affairs of the Russian Federation Council, said that peace talks between Russia and Ukraine will definitely take place. But when it will take place depends on the Western partners of Ukraine, such as the United States and the European Union. Contradictory to what actor Zelensky said before, that as long as Putin is in power, there will be no chance for a peace talk. In my personal opinion, it's likely due to winter being on its way, and both sides no longer have the will to continue fighting, under the double blow of both the weather and the economy. As for the Fed's turn, the third quarter earnings report have shown that many large companies are not doing well, and what can be expected is that the poor fourth quarter earnings will continue. Large-scale layoffs have already begun, which is technically beneficial for easing inflation. But because the rate of wage increment in such a short period, it is expected that after the Fed finishes raising interest rates in the first quarter of next year, at least one more quarter of high interest rates will be maintained to drop inflation, before moving on to the real turn. That is, to reduce interest rates, after which you can declare the end of the deep bear market. Once the crisis is lifted, and you can also start to properly invest in some emerging projects. Finally, the once-in-4 years bull market in the cryptocurrency market will start again in 2024. This is a point Guizhou maintains from June. The forecast is that in the second half of 2023, the Federal Reserve will begin to carry out interest rate cuts and implement an easy monetary policy. Inflation will drop significantly and eventually return to normal, and the consumer market will pick up, all of which will allow the US stocks and the cryptocurrency market to return to the bull market. Moreover, after a deep bear market unlike any other, the next bull market, even if it is just a normal bull cycle, the coins that fell in this deep bear but survived, are bound to have a very good return. That is until the bubble at the top of the next bull market appears. Of course, if you have faith in me, let's start hoarding coins together. Well, that's it for today's show. If you like our content and would like to see more, please like this video and subscribe to the channel. Thank you for watching my show. This show only represents personal opinions and does not constitute as investment advice. We will see you next time.